2, 1. All right. Welcome to Quant Box Live. Let me remind you that trading is risky, not appropriate for everyone. Past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. So I'm going to tear up the script today and go a little fast. We got to do some deviation to revisit why the entire global stock market is collapsing and bond markets are rallying. What's going on? For example, last night in the Japanese stock market had the largest decline since the 1980s. Yeah, 1980s. May say what? Yeah, 1980s. Okay. So what's going on? I started the webinar early where people logged in before the recording, and we had all these experts on TV with global bankers grasping at straws to try to rationalize what's happening. And they're talking about, well, the yields did this and the spread did that, which means they're just explaining the observations they saw. They're describing different parts of an elephant, but for them, the room is dark. They can't see the animal in front of them. They're guessing. They're like, it has a big trunk. Yeah. The spreads are what? Yeah. Why? Why did it do it? Why did it collapse? Why Friday? What happened? And they don't know. They don't know. They literally don't know. Okay. So let's go back. I've taught this before. In fact, this is something that the Council of Investment Advisors has been reviewing month after month after month after month after month after month since November. Every single month, at every single meeting, we review this. We have our own spreadsheet that predicts the trigger. So we saw the trigger coming. And we knew stuff that is really detailed. And the thing with the model is it's looking at different variants of the unemployment rate. And I think they might actually explain it. It's the Sahm. This is the Sahm Rule. This is the model we've been looking at. And what you want to use the Sahm Rule for is predict a recession faster than everybody else, because the traditional way to predict a recession is 2 quarters of negative GDP. Now, that's not even complete. It's 2 quarters of negative GDP with falling employment. Because if you go back through history, there are times when we have 2 quarters of negative GDP, but employment is strong and we don't really go into a recession. So even that definition is dumb. But in those cases, guess what? Well, unemployment starts falling, and then you go into recession because people are worried about losing their jobs, and they stop spending, and then you get a negative quarter, and then you have to get another negative quarter. And guess what? It takes a minimum of 9 months to measure a recession. So by the time you're in recession, you're already nearly a year late in the decision-making process. Okay. Which is not helpful at all. That's like being told that you've been run over a bus. I'm like, well, where were you 5 seconds before the bus hit me? And so we did this. We used this in the Council of Investment Advisors to help us manage our risk profile of investing the pension fund's money. And so we tracked it month after month after month. And part of this measurement and the other parts of QuantBox, we rebalanced the entire portfolio very significantly in preparation for what's happening today. Okay. And part of this was the Sahm Rule. And the interesting thing about the math is if we didn't get a big spike in unemployment on Friday at non-farm payrolls, mathematically, we would never actually likely even trigger this. So it came down, and I swear to you, this is true. It came down to we got the number on Friday or we didn't. We never would. The idea is, the analogy I've used is when you're returning back to Earth from orbiting the moon, okay, you got to come in back into the atmosphere. If you come in too steep, You create too much heat and you burn up into the atmosphere and you die. If you come into shallow, you skip off the top of the atmosphere and you go off into space for infinity. Which one sounds decent to you? So in this case, if we didn't trigger the Sahm rule on Friday, mathematically, we were not going to ever. We would just skip off the top of the atmosphere and go into space forever. We literally hit the soft landing narrative. Well, those who know now know that we are already in recession. And so they're adjusting. And then the people on TV are describing what happened after people have already adjusted. So we had a Fed meeting on Wednesday. The Fed meeting before we got we got the Fed's policies, great. Then we got non-farm payrolls. Then the CIA, the Council of Investment Advisors, met and we analyzed all this and we already knew all this. Cool. And because of the risk, we rebalanced the portfolio to not be hurt if the NASDAQ has fallen. Oh, did the NASDAQ fall 10% since then? Yeah. Are we exposed? We removed 80% of our exposure to that asset. So I'm just saying, we're not surprised at all. This is part of what you're learning in these. And now I've explained the Sahm in other degrees, in Quant Box and our live streams and stuff like that. But this is something we watch very, very, very every single meeting. Every single meeting for 8 months in a row. We spent time on this. And now, just so you understand it, the Sahm okay, they call it the Sahm recession indicator, signals the start of a recession when the 3-month moving average of the employment rate rises by 50 basis points, okay, or more, all right, of right, relative to the minimum of the 3-month average from the previous 12 months. So it's quite esoteric, right? So Joseph Urban modeled it all out, and we like to look at it and then play with the different numbers of different outcomes. Like if unemployment does this at the NFP, what does that do, and to trigger, and what would you need it to do? And we have all these different scenarios: base case, worst case, best case, all that kind of stuff, and we know mathematically what we needed. Okay, so when you go all the way back, you can see, when it triggers, the vertical lines are recession, vertical line, 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 recession. Even this one hit. Okay, and so if we zoom in, okay, there's the 0.5. You see? Guess what? 0.53. What does it mean? All right. Well, did you notice that every time it's triggered in the past, we got a recession? So how come we hit 0.5, 0.53, which is above the 0.5? So we're 3 points above the 0.5. How come we don't have gray lines yet? Anybody want to take a guess? How come the Fed said, okay, it triggered, but how come they haven't drawn those vertical lines? Anyone want to take a guess? Yeah, they're going to tell us 9 months from now and go back and draw the vertical line. They'll do it next year. No, Clinton, it's not to avoid panic. It's closer to Brian's, where you like, well, you need 2 quarters of negative GDP. So they go back and backfill it after. Okay. So after the last Fed meeting, now 6 weeks ago, the CIA removed 80% of the exposure to NASDAQ because it has the highest beta. So if we go into recession, it will fall the furthest. So we got out of that. But by the way, at the time, that was our most profitable trade. Now think of the psychology. This is what I'm teaching. Forget about the what and the how. Think of the psychology. We meet, we're thinking like, dude, we're literally next meeting, the United States is likely to be in recession, or at least a very, very, very good chance. Plus seasonality, anyways, right? So we perceived the risk. And then what did we do? We bailed on our biggest winner and rotated it really into the biggest loser because we hadn't had a bond market rally yet. Do you understand? The bond market is crazy rallying right now. And we put now 30% of the portfolio into treasuries, and they're just kicking ass now. I mean, crazy moves now to the upside in the value of those assets that we just bought 5 weeks ago. And if we had stayed with NASDAQ, we would have, the bottom would have fallen out. And that asset has been horrible. But we took profit and moved it. We took our money and ran at precisely the right time. QuantBox and Sahm were used in those decision-making processes. And to me, it's like recognizing the risk and having the strength to manage the perceived risk. See, when we got out, NASDAQ still went up. Didn't matter to us because the chance of the risk went up that was going to collapse. That basically like a house of cards. We looked at the Sahm Rule almost certainly being triggered. And then we also looked at seasonality. So we're like, oh man, NASDAQ's crushing it right now. Good, let's get out. And treasuries have done nothing for weeks. Good, let's buy a ton more. Think of that. And it was not an easy decision. We probably talked about it for 3 hours, different scenarios of how to handle it, what percentage. Okay. And let me tell you, again, when you see these guys on Bloomberg and CNBC that manage $1 trillion or oversee a global bank, they don't know. Then none of them just said, well, our models have triggered that we had just entered recession, and our mandate is to like rotate out of risk and prepare for a recession. We went into recession mode. They did that. No, they're describing, well, it's a big animal. It's got a little itty bitty tail on the back. It's got giant legs. We know that. It's got a trunk. They're just describing observations. But none of them said, it's an elephant. We can see it. We're looking at it. We saw you bring the elephant into the room. Like, it's an elephant. We're staring at it, right? Dude, we're in recession. You don't know? Well, let me tell you, a lot of people do know. But the people on TV don't know. People in the CIA, my Council of Investment Advisors, we know it in great detail. And all the information's in QuantBox as far as other things like seasonality and all that kind of stuff. So it shouldn't be a surprise at all. This is where you find out who actually knows what's going on. Any idiot can make money on the way up. Okay. It takes a strong trader and investor to recognize and perceive the risk and the potential for risk in the near future. And the strength comes from the ability to get out of something that is your biggest winner. What does a weak trader do? Stay on the biggest winner and ride it all the way down. Instead, get out of what's worked for 6 months to a year and move it over to something that's not working under the current conditions. But see, the risk is the current conditions are going to change soon. And even if they don't, you did your economic research and you knew the probability was extraordinarily high that the economic conditions would change. So it's not about being right. You know, the what I've been saying lately is it's not about predicting for the future. That's like, you know, predicting an earthquake. No. I don't predict, we prepare. And in this case, we knocked it out of the park with real money, by the way. I think we moved $25,000 into treasuries. I mean, like, not a joke. Okay. Of my money. Yeah. Real. Totally real. So the Fed won't tell us we're in recession until you've already lost your job. You've been kicked out of your apartment, whatever, you know? Hey, you were run over by a bus yesterday. You're like, thanks for the update, bro. I figured that out when I woke up in the hospital, right? What's more important? Someone yells, look out before you step off the curb, right? So we were ready. Now, Claudia Sahm, I'm not a fan of. Okay. But the model seems reasonable to pay attention to. So imagine these vertical lines, right? Imagine these vertical lines you saw 6 months before they happened. I think it's closer to 9 months because we just printed a 2.8 GDP. Okay. Okay. Well, okay. Clinton says, are we going into a trough? Okay. How many people here attended my special event in January? Charged $4.44, and I predicted the entire year in advance. Okay. Okay. True or false? I predicted the top of the market, the stock market, would be in July. Okay. True or false? The top of the market will be July. Okay. Great. True or false? I predicted the bottom of the market would be the third week of October. True or false? So I still think that because I didn't make it up. The question is, if do you remember why? So when you see these guys that make $8 million a year doing their job, it's a job, and they're making 2, 3, 4, 5 million a year. You should know more than they do. No, but things did change, right? So, Brian, I said that in January when people were saying January, February, March, we're going to be cuts, and then they would slow it down. At that, when I said that in January, Brian, there was 6 cuts already priced in, and I spent 2 hours showing you all the reasons why that is impossible. That there's no way that was going to happen. And my best guess at that time is we would have 2 cuts, July and December. Yeah. And then, of course, by the time we got to July, things had changed, right? But it still makes logical sense. And we'll probably still get out of here with 2 cuts, or they're going to like now freak out that the stock market's falling, right? So who knows now? Maybe the Fed comes in, does 3 in a row, or does 50 on the first. But yeah, that is true. I also said that. But within the 6 months between that period, things have changed. But I don't think I'm far off as the absolute number, right? So right now it's September, December. Okay. It's just a deferred, right? but things may have changed because I know here's the other thing. I know the Fed knows the Sahm Rule, and I think they were actually waiting. And I think they had the same type of spreadsheet or database that the Council of Investment Advisors have. Now, Joseph Urban put a lot of time and energy building the model for us, but I believe the Federal Open Market Committee and the Board of Governors and all the staff, they have their own model too, and they could see the glide path into a September cut. I think they were going to cut in July, Brian. But we had that period, do you remember, where suddenly sort of inflation came back and NFP was quite good and the unemployment rate actually fell a little bit again. We had like I think it was April. And what happened is it shifted the model from July to September. And so again, our little group of retail traders are investing my pension fund money. We were able to say, no, it's September. Yeah. So I think the end result here is it changes either the speed or the amount of cuts by the Fed. They either cut like 50 basis points right away, which was not priced in, or like Goldman Sachs now says that they do September, November, December, and continue into next year, right? Or the absolute number of cuts. So one of the things I've been thinking is we get to like 4.25, 4.5, maybe 4. But in this case, as they're cutting, maybe they go to 3 now instead of 4. Okay. Yeah, that's right, Brian. So in June, they were worried about it, but it happened in April. And if you look at the stock market collapsed in April around that discussion, right? So there's like a somewhere, anyway. So the collapse happened after the sort of the March meeting, right? So anyways, guys, you actually know now. So if you have friends and family that turn to you because they know you're a Forex trader and they're like, so what's happening? I heard that, the markets are on fire, right? Or I guess collapsing. Um, what's going on? And I want you to be able to say that the Sahm rule at the Fed triggered a recession, or an indication that we're already in recession, and nobody else will know until next year. So you might want to start acting. So 6 weeks ago, I already rebalanced my retirement account. I'm fine. I'm making money on this. This is great. I'm happy. How many people do you think are happy right now? Let me say it again. I just got knocked out of my yen trade from 2 weeks ago with 2,000 pips profit. Unfortunately, I left a limit order. I had to take profit order for 2,000 pips. I hit it in 2 weeks. I took the trade on a 5-minute chart too. It was technically a scalp. I scalped 2,000 pips. And now I'm out. I'm out. I felt bad. Like, oh my God, I guess I should have gone for 3,000 pips. Amazing, right? Yeah, but it's all preparation and understanding. I think that's the biggest trade I've done on the coaching account. You know, I've made many, many times 1,000 pip trades. I don't recall ever making a 2,000 pip trade. Not in 2 weeks, anyways. I made 10,000% one time, and it took me 10 months, but that's a pretty good one. Yeah, that's a pretty good one. I think it was 15 to 18x, I think 18 times return on investment. So anyway, so look, my point, and I said this actually last night to the day trading group, is if it's true, I don't know. Maybe we don't go into recession. Maybe this time it's wrong. I don't know. But if you think there's a potential that the stock market drops for the next 3 or 4 or 5 months, or maybe it's really a bad one and we're in recession for a year and a half. I mean, we don't know. What's next? Commercial real estate? Actually, it'll benefit from the falling yields. But let's just say you need to adjust if you can adjust. Maybe you're retired and you're in a retirement account and there's very little you can do. But other people could maybe, like maybe there's stuff you can sell now and go to cash. And then in October, buy the stock market for 30 or 40% cheaper. Maybe, normally in a situation like this, houses would lose prices. I don't think that's going to happen. So the only thing is you're going to likely get a stock market decline. But will you have the cash to buy it back 30% cheaper? What are you going to do? Are you just going to ride it out? Well, my retirement account, much of it we will have to ride out, but we've reduced our exposure as much as possible and then did move money into something that should perform quite well. So we're good. Okay. Okay. Yeah. So, anyways, that's that. That's that, and that's the St. Louis Fed. There it is. Okay. Cool. Yeah. Uh, uh, yeah. Anyways. Yeah. So that's that. I guess let me bring that back. Uh, we'll have to log in and now just do a quant box review. So think about it. Do you see the risk? What can you do about it? What should you do about it? Are you going to do anything about it? There are lots of indicators showing that this was on its way. Some is just using the unemployment rate. But I told you 6 months ago when I was shopping for high end Porsches, GTSs, and turbos, you couldn't get a deal anywhere. Then you did get inventory showing up because suddenly the same cars were there for 3 or 4 or 5 months. Suddenly I recognize all the cars. They're not selling. And then prices started coming down. And last week, somebody offered me a turbo for $10,000 less than it should be. And I still don't think they're selling. So I might approach them, I don't know, September. See if I can get it cheaper. Okay. Now, Clinton says, why not short instead? Well, you can do whatever you want, Clinton. Okay. But, there's all these little signs where a year ago you couldn't even get a decent car, right? And they were very high priced. 2 years ago, car prices were going up. Used car prices were going up. Okay. And now these high end cars are not moving, prices are collapsing. So I'm going to wait until there's blood in the street and get myself a turbo. That's how wealthy people become wealthier. Now, that's pretty petty to buy a fancy sports car. I did it before. It's just when you do buy fancy sports cars. But if you can buy an apartment building or a skyscraper or an apartment complex with, 500 doors and you're buying it for pennies on the dollar, that's how you become filthy, stinking rich. Or you just buy the stock market after a 30% decline and then hold it forever. Okay. But I want you to be prepared to do something. Clinton's like, sell it. Great. Dude, great. Do it. Okay. Sometimes I put you can get leverage positions. You can short 3x. All right. Anyways, let's get on with it. Now we got it here. Okay. So I bought I bought, we'll say this, I bought 20s because of the convexity of bond yields and all this crap. But anyways, I bought this when the yield was 5. It's now way below 4. Look at this 5% change in one day. Holy crap. What does that mean? Yields down, price up. So when I bought it at 5, it was the bottom of the market. The bottom of the market, the lowest price in years and years and years and years and years, probably going back to the 2008 financial crisis, right? Like incredibly low price. And now it's skyrocketing. Cool. Oil's way down. Be careful for a black swan event on this. Yeah, a global recession would drop demand and oil would come down. The United States is producing huge amounts of oil right now. So that would also bring it down. So if you have supply going up and demand going down, yeah, the value of this could be quite low. So look, this could drop to 50 without a problem. But if we get war in the next couple of days, be ready for that big black swan. If Iran attacks Israel, which is almost certainly going to happen, and it looks to spread tensions, yeah, get ready for up on oil, on geopolitical risk. But just don't do it blindly, because falling demand and increase in supply, I've seen oil drop from 72 to 0. So just wait for the geopolitical or be ready. Okay. Gold is interesting. If inflation comes back, but inflation won't come back if oil's falling. But if it does, so right now it's negatively impacted by a collapse. So that would just be collapse in aggregate demand, I suppose. Bloodbath going on in the S&P 500. That's Friday's cash rate. I think futures are down 3% for the S&P the last time I looked, but for Nasdaq futures were down 4.5%. Okay. Yeah, Clinton. Yeah, you're not doing anything, still starting. Well, so like my pension fund is not really a trading account, is it? It's an investing account. So I'm more interested in the longer term perceived risks and managing managing that through diversification and a bunch of other things. Oh, thanks, James. Yeah. Jim's like, yeah, 3 and 4. Yeah, yeah. Well, those are big bad days. Okay. Bitcoin. I mean, just last night we looked at it and talked about the drop from 70 and it was like 56. And I'm like, it looks like 50 or 35. And the sad thing is, I know some of you guys were interested in buying it, and I think it was closer to 55. And I'm like, okay, well, that doesn't look like it's going to hold and could be a lot further down based on just technical analysis. Because suddenly, I think what we're looking at in crypto, oops, actually, that was it, but I just deleted it. But like, you get this, and then we kind of did this for a while, and suddenly that. And this was like 55, right? So what does that point to? And oh my gosh. So if you have the hodl, well, hopefully your hodl is you got knocked out of break even. Hold on for dear life. But the sort of the downside of that is you were probably up 15% and didn't get a chance to take profit. Now I got knocked out and I was sad at the time because I made like 4.5%, I think, on Bitcoin in like 4 days, and I got knocked out with only 4.5, and I was crying. Yeah, I'd probably be down 20% if I didn't have my +4. So suddenly I'm like, now it seems good. Whatever, right? This is complicated. Okay. All right, let's take a look at risk gauges here, and this is likely to change quite dramatically as the United States opens its markets. Um, but it looks like a flight to safety already on the hires. Now we're letting this load. Um, I don't know why Google's so slow today. But anyways, looks like we have risk off from Friday, and that's likely to continue. Excuse me. Sorry, it's all that ghee I put in my coffee. Uh, the interesting thing is all of this makes sense except the dollar's weak. And I just wonder how many people were long USD yen. Apparently, a lot. So we dropped. So, the key line in the sand that we've had for the USD yen, right? Yeah, I guess so. Hey, James. But, it helps me lose weight. Adding fat to my coffee helps me lose weight. It's strange, but it's true. But um, I would never have longed USD yen, but I guess it makes sense. It was a good carry, and you're shorting um, along with basically the Bank of Japan and all that kind of stuff. But it seemed to be like a lot. So we're in this situation where I totally would think the dollar would be strong, like not even a little strong, very strong, but it's very weak. And it tells me, well, it must be related to either the Japanese yen or the Swiss franc, but we know the yens are moving like cray cray. Again, the largest stock market decline in Japan since the 1980s. Last night while you were sleeping. Okay. And dollars weak. NASDAQ's down 4 and the dollar's weak. That just shows you how many trillions of dollars were long USD yen. And the main line in the sand was 50, and we were way above 50. And then last night or Friday, we came down and tickled the 150 level on USD yen. And we're like, oh, okay, that's the interesting level because it used to be resistance a million, like earlier in the year. And now we're back. Will it act like support? The answer is no, because now we're at 140. It dropped 1,000 pips last night and I already was up. I already had 1,500 pips profit. I woke up today and it's gone. I'm like, what the hell happened? Oh, I hit 2,000 pips profit and I got taken out. That's a pretty good 2 weeks, my friend. How did I have the confidence to let it run? Quant box. Okay, I don't know why Google is so slow. This isn't us. This is Google. Okay, let's go to the scatter plot. It's less intensive as far as doing the calculation. Bitcoin bloodbath. Okay. The thing is, now what? Yeah. When do you buy it back? October? I don't know. That's the thing. Like, if my analysis is even remotely correct, and it does fall till October, what would you do if that's correct? Is Bitcoin on the way to 30,000 from 70, 35, 50? Well, we're at 50. Is it 25? Is it a reset? Is it a winter? I don't know. Are you thinking about it? So you remember, you're trying to become a professional, which means people would come to you and ask you for advice, and well, that means you better think about it, huh? Yeah. Let's adjust the scatter plot. Look at Nikkei, bro. -12 last night for the cash stock market in Japan. The spot dropped 12%. Oh my God. What would you do today if NASDAQ drops 12%? This is why I started the meeting actually an hour early. I want to make sure you're around. Now, I noticed we might have a couple other people in the CIA. Uh, I think I'm going to move it till tomorrow. That it works for Jean Guy. Is anybody else here? Yeah, Denise, is tomorrow okay? Okay. Yeah. I gotta suddenly, I'm in crisis mode on behalf of a lot of people. So, right. The portfolio is fine. Yeah, some of our positions are going to lose money, but we're fine. Where other positions are going to make money. So I'm not worried about me. Um, we've already done a great job. So, so if we can move that, that'd be cool. All right, cool. Tomorrow's good. Nice. Whew. All right, so we can move the stock market and yeah, commodities are weak. Aussie, Kiwi, okay, euro doing well, but you know what that is? It's just a sign of weak dollar. Okay, dollar weak, dollar strong. Ooh, Aussie's worse. Ooh, look at that. Maybe dollar comes around today. Ooh, that would make sense. Ooh, could be a buy the buck today. All right. See, that gets me interested. Interesting. Cool. See, all this is probably going to change, right? All right. This money market, if this is falling, my investment into treasuries are making money. Look at the acceleration just recently. Not only is it been trending down, look at the acceleration. Huge day on Friday, and most likely today, huge day. Those 20-year treasuries are going to pay so good. Okay. Good. Nailed it. Okay. Money's getting cheap. Anyways, we'll leave it at that. Money is getting cheap, and the market thinks it's going to get cheaper. Option market has not warmed up yet. Okay. But definitely Friday was risk off. Can you clearly see? It went from whoa, kind of risk off, huh? Holy smokes. Now remember, this is analysis of 1 billion options contracts. We were going to do more than a billion, but it seemed ridiculous. So we only do a billion options here. And that entire market says risk off. Hmm. Brian says, when will I take profit? Never, because we're writing options on them, Brian. So the value of the assets are going up now, but we're earning, get this, Brian, 15% annual income, 5% on the treasuries, and then the rest, 10% on the options. Ah! Oh, it's like, yeah, I use them as collateral, and the value of the collateral is going up. Oh, it's sick. It's sick. Yeah, yeah, it, yeah, yeah. Oh my god. Yeah, I'm staking them, bro. All right, heat map. Again, I think a lot of these are going to update in a few hours. So you might want to check this because you know, well, I guess not. Okay, gold is up 3%. Okay, okay, okay. Euro has been positive. Okay, Euro's had a good week. Okay, all right, okay, all right. Bitcoin down 23%, Nikkei down 18%. Look at the yields. This is right down 10%. So that investment just week over week for me, let's say in theory, if yields drop 10%, then maybe the price went up 10%. That's a nice week for anything, right? Yeah. Yen down 9% here, right? Pound yen down 8%. So this is the one I was short for 2 weeks. Bruh, bruh. Okay. So, anyways, there's some big moves. Now, Russell was up 12% because we were pricing in a soft landing, yet the Fed was going to cut rates. And that is good for small businesses because they tend to borrow and lease a lot more than trillion-dollar companies. Why would you lease? You just buy it, right? So these companies lease. But now, if we're going into recession, well, that's not good for small business. Even if you cut the interest rate, if they can't pay their mortgage, if they can't pay their rent, doesn't matter. And if they can't refinance, so yeah, rates come down, but lending standards go up, and they can't refi at the lower rate. Does it matter? Also, if the Fed cuts interest rates, um, does it make you buy a new house? Maybe, maybe not, depending on how much mortgages come down. But if mortgages drop to only 6%, I'm not going to sell my house because my mortgage is 3%. Like, I'm not going to sell. Okay, well, then we need to build more houses. Great. Then we need more workers, but we're going to close all the borders. So we don't have any people to hire. There's not enough bodies, right? And so there's a lot of constraints on our economy. I think we have a quiet week. Okay. Hmm. Google is slow today. Okay. ISM services. Yep. Okay. Okay. That's a biggie. A bad number on that would be devastating because the market is so sensitive. Okay. Aussie interest rate decision. Great. That's tonight. Okay. Kiwi jobs. Probably not that big of a deal. We're worried about big, big problems. More, right? More Kiwi stuff, fine. Jobless claims, fine. CAD jobs, fine. Not a big deal. A bad number on ISM would be devastating. So anything below 50, if it comes down 49.9 on ISM services, we're in recession. That's even if that's not quite true. I mean, I showed you the Sahm rule. So you could, and I think the smart money knows this. Just shows you again, you could be the head of a multinational bank and not be the smart money. They don't know what everyone else knows, and obviously everyone else is trading what they know, but those guys don't know what everyone else knows. So it's really strange, right? But anyways, for those that are trading that the United States is already in recession, and anything below 50 on ISM services represents that 70% of the US economy is actually in recession. And that's services. Well, what about the other 30%, which is manufacturing? Actually, government is some. So let's say government is 10. So 20% of the economy is manufacturing. It's already in recession. So if this comes out like previous, like below 50, on a day like this, where we're already pricing in almost certainty of a recession. Oh my gosh. That's going to take us down another 2%. So be careful around 10, man. Be careful around 10. The rest is earnings. But once again, earnings have been disappointing so far this quarter, which shows us last quarter we were already sliding into recession. You see, it starts adding up the long and variable lags. Well, right, have come home to roost. Okay, I'm not going to do any forecasting. I'm not going to do. I mean, we're going to do COT. I'm not going to do fundamentals on stuff. Look, we could do NFP or something, right? Um, okay, good. See, it was updated. Um, it's low, man. It's low. And notice the revisions, okay? Low. You see the red candles are lower than the green candles. Okay, what does that mean? 150. We added 150,000 less jobs than we thought recently. The numbers have come down consistently. So, if that continued down, 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 oh. So look at this, down, down, down. So 90, 105. Okay. Yeah. See? So, yeah. That's 1, 2, 3 revisions in a row. Down. We were wrong. Okay. As far as inflation, you could look at wage growth. Okay. And what came out? Okay. Again, that's funny. The timestamp is 1 hour wrong, I think. 3.6. Okay. Look, what's the let's do yeah, this is the one that doesn't update. I forgot to tell them. Anyways, look, we go back 1, 2, 3, 4, 5, 6, 7 months ago. Okay. If we went 7 months ago, wage inflation was at 4.5, and now we're at 3.5. Okay. It's 25% less wage growth up. So we're in the wages are coming down, if you want to look at it that way. It's not quite true. The increases are slowing down dramatically, but that's a future a prediction of future inflation, if you will. Okay. Now, if we start printing negative NFPs, this is going to come down hard. And that means consumer spending is going to drop, household income and wealth will drop. Okay. And then that's the problem. Okay. And then you'll say, well, now we're in recession. Okay, great. So you were run over a bus a minute ago. Does it matter at that point? Okay. We already know. And we all this data in QuantBox is showing you something's happening. The thing is, the Fed is in control of it here. What if they're not in control of it there? Okay. And I think there's even a chance where this drops, we go into recession, people are losing their jobs, GDP goes negative, and then inflation goes back up. And now we have a collapsing economy and rising inflation again. So we have negative GDP and 4.5% inflation, 4.5 CPI and a negative GDP. What would you do in that scenario? Yeah. What would cause that, by the way? Geopolitical risk pushes oil up to $100 a barrel. Meanwhile, our economy is collapsing because the Fed was too late. Okay. Now, think of it too, their logic. I believe the Fed was using the Sahm Rule to know when to cut. But the problem is you're already in recession when they got the number. So they had sort of a flawed strategy, if you will. They could have waited to say within 3 months of a Sahm trigger cut to avoid the Sahm trigger. But that's not what they did. So now maybe they're too late. All right, so let me do the COT and I'll let you out of here. It's going to be an interesting day. And I might do, I'll probably take a quick break and then maybe at 8:15, I'll do the YouTube stuff. And then just focus. I gotta, I gotta have focus. Now, check this out. So that's not updated, is it? Denise, help me, Denise. Is that Tuesday? I mean, what is the timestamp? See you, Burn. No, that's right. Yeah, that's Friday. All right, cool. Yeah, okay, good. So funny. I don't know what date it is, but I know when the news comes out. I swear to you, I was planning my 6 months in advance or something. My dentist next to dentist appointment. She's like, "Well, how about this date?" And I'm like, "No, I got NFB that day." She's like, "What?" "Yeah, jobs reports are being released." They're like, "Yeah." She's like, "How do you know that?" You got to know everything, baby. All right. All right. So gold, interesting. CAD, interesting. This is likely to change if we go risk off. This is going to change if we go risk off. All of this isn't changed. This is all from Tuesday. Now, reported on Friday, but this is from Tuesday before Friday. So this does not reflect the world we're in. This reflects the world we were in. Now, is it useless? No, not to us, in particular if you're learning. Okay? So, we had a 5% increase in yen and Swiss franc. Did somebody know risk off was coming? Look, Swissy, 85% of the market is short, but there was a 5% increase in bullishness. Somebody flipped. Now, it's still 85% short, but somebody saw it coming. Somebody did something. 6,822 less bears. Okay. And 2,000 more bulls. And it moved the mark, right? Moved that. They were ready. Okay. This 5% made very smart decision. Now, if we're going into recession, these guys that moved money into Russell, they were late. Now, this was the rotation going on. What this isn't necessarily bad. What's happened is money came out of NASDAQ. Okay. And maybe some out of SBS, or SPX in this case. But it's not necessary. NASDAQ is more likely. So NASDAQ money over the last several weeks, like a month, was coming out of NASDAQ and going into Russell. The idea here is if the Fed cuts, these guys will benefit the most. But the new news is, yeah, the Fed's going to cut, but we're going into recession. So, yeah, guess what? You might be able to renegotiate the lease on your factory, but you're also going to lose 30% of your income because your customers are going to stop buying. Well, hell's bells. Okay. So the narrative has changed, but you can see the logic that a lot of money was going into the Russell. That is not likely to continue. Less shorts, more bulls, very, very bullish. And then this and this was the right thing to do, right? That was smart. Anything else? No, not big moves anywhere, really. Lots of money coming out of the market. Okay. Look at like less bears, less bulls, less bears, less bulls, less bears, less bulls, less bears, no new bulls. Okay. You can see there's a lot of people just going to cash. Less bears, less bulls on gold. Okay. More bears on CAD. Okay. Remember, for weeks now, sell all the commodity currencies, right? Aussie, CAD, all that kind of stuff. And you can see sell Kiwi, massive. Sell Aussie, massive. Sell pound. Look at this. What happened? 22,000 less bulls and 8,000 new bears. Oh my gosh. 12% less bulls, 17% more bears. Wowzer. Big change of direction. Yeah. Nikkei. Look at that. All right. What happened here? Many fund managers have been long the Japanese stock market for years. So they're not, right? So they're not actively trading this. Some people took profit, nobody sold, which means they were not ready for the bloodbath that happened today. This asset dropped 12% today. Huh? The biggest drop since the 1980s. Okay. To get a sense of that, I was playing with G.I. Joe. Okay. Madonna was a young girl dancing around the screen in fluorescent lace gloves. You could be my lucky star. Like, bro, that's a long time ago. Yeah. These guys didn't see it coming. Now, I had already been buying the yen a week before this. So, yeah. Clinton says, well, be careful with your language. You're doing this. You're doing this. I have, as your coach and mentor, I have to have you change your language. You're not programming your brain right. Right? Don't say things like it should explode. No, no, tone it down. Try to be professional. So, is there potential for US dollar to strengthen? Yeah. Yeah. I would normally think so. The normal correlation with risk off in US dollar would suggest such. Um, I thought about it overnight, and I believe the like last night the dollar was weak, and I talked about it for at least 10 minutes about like normally it's strong. So what is going on here? And it just there were so many people long USD yen that the collapse, and we're talking about thousands of pips now. But once that's over, like let's say a 2,000, 3,000 pip drop takes everybody out. Like it totally clears out that carry trade. Is it possible now then the money goes into like risk off mode, like dollar strength? Yeah. Yeah. Once that's cleared out. Yeah. Okay. Yeah. And will that happen today? Yeah, that would be something that I would be looking for. Yeah, for sure. And Quantbox tells you that, by the way, on the risk gauge pages. Okay. But anyway, so what I'm seeing in this report is that some people either got lucky or positioned things well. They perceived a risk and they adjusted. They didn't adjust in the Russell. They didn't adjust in the Nikkei. Um, and these are things that, in particular, I think American hedge fund managers are overly confident on, and they paid the price last night, and on Friday. And for those that don't know the Sahm Rule, they don't know what's going on. They're going to describe what's going on. Oh, if the dollar strengthens, they'll say, well, the dollar strengthened because NASDAQ is down. Okay, great. Why is NASDAQ down? Well, the Fed, the change in, and now they're just giving you more observations, but they just can't say, oh, well, our models have triggered that we are recessionary. Now, by the way, not everyone. You will hear some people today. You will, not just me. I'm not like some economic angel or something. You will hear people today talk about the Sahm Rule, write their names down. In the hour, because I started this webinar an hour early as I was just working, I thought if you had questions, you could ask early. But so I started and just ran the news. In the 3 or 4 guests they had in that hour, those people did not know. But there are people that do know, and they'll come out and they'll just say, oh, well, we're in recession, which means they know. Where did they get that call? They used the Sahm Rule because they didn't say it on Wednesday. They said it on Friday and a Monday. And so write their names down. These are the people that know, and you know, you could potentially listen to in the future. And you don't care about the other people's opinions. They adjust to market conditions, but they don't prepare for them. I think there's a big difference. And those that guess and predict, ignore them completely. They're worse. They're worse than not knowing. They entice you to buy the magic beans, and that's worse, right? They don't make the world a better place. Okay. So that's it. I'm not going to go through like scorecards and all that just because, well, what's happening now is not supply and demand or some long-term economic adjustment. Like we've had all of that. We saw a lot of these things coming. And now we're in panic. It's not really panic, but the avalanche is a snowball effect where the market drops and somebody's stop is hit. So that creates another short, which drops the market more, which hits another stop, which drops the market more, which hits another stop, drops the market more, hits another stop. And it's just now like an avalanche. The cascading effect. I've also used tsunami. Do you remember last week when I said, imagine you were standing on the beach and you said to yourself, where did the ocean go? This was me just last week, ladies and germs. And now the ocean's come back. And it's devastating. I said, well, last week I said, when you notice the ocean's gone, it's probably a bad thing and you should prepare. And now the tsunami's here. I hope you prepared. And if you haven't, I hope your hammers are dropping into place. Okay? I hope you're seeing the education that's being provided. This is really complex stuff. And the trending part is the easy part. It's the change in trend that's difficult. Okay? That's a very difficult, even for the models. Most models don't predict any change. Right? So being able to pull this together as a team is really important. It's really difficult. It's never going to be easy. Imagine when I moved 30% of the portfolio into treasuries, dumping the NASDAQ, and the NASDAQ was still going up. Did that feel comfortable? No. Was it an easy decision? No. Did the committee just follow like my suggestion? No, we had long conversations on what to do and how to handle it. It's not ever going to be easy, but I want you to be more focused on the idea of no predictions, but only preparation. Therefore, you can say, well, there's obviously a risk coming. It's seasonal. At the very least, it's seasonal. And therefore, we must prepare. Just focus on the preparation. There's not going to be an earthquake tomorrow. Okay, well, we should prepare for one if you live in California. Oh, there's not going to be a hurricane tomorrow. Well, if you live in Florida, you should prepare. And by the way, yeah, there might be one tomorrow. Okay. So on and so forth. And it won't happen tomorrow, but you should be prepared. I gave, again, a week ago, 2 weeks ago, I forget which group this was, but I was talking with people about, you know, that I have food and water and blankets and medicine and everything just in case there's a hurricane that or a tornado that hits my house. It's all prepared. It's in a little safe room. And once a year, we have to replace all that stuff so we don't have rotten food and stale water. We're prepared. And I think if you are prepared, you can weather the storm. And let me tell you, most people are not. So I hope you value the team you're on. I value you being on the team. And I hope in times like this that at some way I bring like some comfort or safety. And in return, I also hope you do something to protect your friends, your family, your loved one, your money, um, your dreams. And I'm always here for you. So peace on earth. May the pips be with you. May your profits be above average. Be careful out there.